Hi, my name is Christian Waldegrave, Head of Research at Teekay Tankers, and this is our conventional tanker market update for December 2019. Well, it's been a while since we've done one of these update videos, and I think it's fair to say that a lot has changed in the tanker market during that time. Just going back a few weeks to the third quarter of the year, Q3 was quite a weak period for tanker rates, and that's normal for the third quarter. It's a time when refineries go into maintenance, and we always see rates dip into Q3. This year, Q3 was probably a little bit worse than we anticipated, and we think that's because refinery maintenance was a bit more extensive than usual, because refiners were taking the opportunity to retool ahead of IMO 2020. And we also saw a lot of high tanker fleet growth through the first 6 months of the year. The tanker order book in 2019 was very much weighted towards the first half of the year, and scrapping has been quite low during this year as well. Because there is an expectation that rates would recover into the winter and into 2020. So that combination of refinery maintenance being heavier than normal plus higher than expected fleet growth through the first 6 months gave rise to this weaker Q3. However, I think it's fair to say that the fourth quarter of the year has been fairly exciting and a bit of a roller coaster for tanker rates. And it all really started in October when we saw this huge spike in rates in the middle of the month, and we saw VLCCs going up to $300,000 per day and Suezmaxes to $160,000 per day. And that was all really triggered by one event. It was the US sanctions on a subsidiary of COSCO shipping, COSCO Dalian Tankers. And COSCO Dalian Tankers has about 20 VLCCs, but I think when the sanctions were initially announced, people really steered clear of the whole COSCO group for a short period of time, which was 140 tankers, of which 50 VLCCs. And in that confusion in the aftermath of the announcement and in a rush to fix cargoes, that's what really caused that spike in rates. Rates did then normalize very quickly into early November as the dust kind of settled around those COSCO sanctions. But through the course of November, the rates have started to come back up again. And by the end of November, we'd seen VLCCs back up to $100,000 a day, and Suezmax is back up to $50,000, $60,000 a day again. So this kind of extreme volatility, the very numerous spikes and the magnitude of these spikes is very typical of a tight tanker market, and it really shows to us that the underlying supply and demand fundamentals have really tightened up, which then allow rates to spike when you get these one-off events and factors. So what has really changed in the last few weeks and months to give rise to this tighter tanker market and this extreme rate volatility? Well, looking at the demand side of the equation, we have seen changes to trade patterns this year, with obviously OPEC production coming down because of cuts and because of sanctions on Iran and Venezuela, but then non-OPEC production coming up, especially in the Atlantic basin from producers such as the United States, Brazil and Norway. And that hasn't necessarily translated into more ton miles. Ton miles, of course, being volume carried multiplied by the distance over which it's transported. If you just look at the ton miles, in fact, they've probably gone down a little bit this year. But that doesn't tell the whole story, because what's happened is that the whole tanker trade has become much less efficient, and we've probably seen more ballasting than we have in the past. And so you can't just look at the ton miles, you have to look at the overall sea miles. And we think that those changes to trade patterns have caused a lot more inefficiencies in the tanker fleet, a lot more vessels having to ballast into the Atlantic to bring those cargoes across to Asia, and that's really driven an increase overall in tanker demand. We've also seen just in the last few weeks and months a big increase in refinery throughput. That's both for seasonal reasons ahead of the winter, and also probably a bit of a boost from IMO 2020 as refiners look to maximize throughput and produce the low sulfur diesel in preparation for next January. And so taken together, that's been a big boost on the demand side. And then a lot of the changes come on the supply side of the equation as well. As I said before, fleet growth through the first few months of the year was quite high. And if you just look at headline fleet growth for the year, that is new build ships coming in versus ships getting scrapped, it's a fairly high year for fleet growth in 2019 of about 5.5%. But that really doesn't tell the whole story. And in recent weeks, we've seen actually quite a lot of ships being out of service for one reason or another. Those reasons being the COSCO sanctions, as I just described. Also US sanctions on Iran, which has tied up a portion of the Iranian fleet. Also ships being taken out of service for retrofitting of scrubbers in dry dock, which has taken a lot of ships out of service. And then finally ships being tied up in floating storage. So we currently have about 25 VLCCs off Singapore and Malaysia acting as floating storage. So when you take all those factors into account, effective fleet growth is actually probably fairly minimal this year. And so we've not seen much fleet growth. Certainly in the last few weeks and months, we've probably seen effective fleet growth actually go down. And then demand has risen, as I've said, because of trade inefficiencies, more oil moving west to east, and a bit of a boost here towards the end of the year because of IMO 2020. And so that's really giving rise to this rate volatility, added to which you do get weather delays during the winter months, and we're already starting to see some impact through the Turkish Straits and in the US Gulf, where we've had some incidences of fog. And so we think that will continue to drive rate volatility through the rest of this year and into Q1 of 2020. So we do expect a strong rate environment in Q4 and in Q1 of next year. Looking further ahead to 2020 as a whole, we think it's going to be another positive year for crude tanker rates. Starting with the demand side, we do think that OPEC will probably cut back a little bit more next year. We're just hearing today that the OPEC meeting's going on right now, and they'll probably announce a deepening of cuts by 0.5 million barrels a day through Q1 next year. But the real story next year isn't OPEC, it's non-OPEC once again. And we could see an increase in non-OPEC supply of up to 2 million barrels a day from the same kind of countries we saw last year. So the United States, Brazil, Guyana, which is becoming an exporter now with an FPSO coming online, and again, Norway and the North Sea. So again, that's going to mean more barrels coming in the Atlantic, having to flow east, which is where refining capacity is rising, and therefore creating more ton miles and more trade inefficiencies as well. And on the supply side of the equation, next year should be a fairly low year for overall tanker fleet growth. We're forecasting only about 2% fleet growth next year, and that's even with a fairly low scrapping forecast, because we don't think many owners will scrap ships in a high rate environment. They'll probably put those ships through dry dock. But it is a small order book for next year. And we think that, again, effective fleet growth could be relatively low, because we will continue to see ships taken out of service next year for scrubber retrofitting. And we'll probably also see some floating storage still going on next year, probably more on the fuel oil, because post-2020 there's going to be a question of what to do with all the high sulfur fuel oil that needs to find a home. And I think in the near term that could drive some floating storage. So we'll probably see a fairly low year for fleet growth next year and a good demand environment, which means that overall we think that 2020 should be another positive year for crude tanker rates, and that next year will probably average higher than 2019. So that's our update on the conventional tanker market, and we will speak to you again next year.